everyone, good evening. You're tuned into the Money Show right here on ET Now. This is the only show of its kind. We get you the top market, top financial experts and tax experts to answer all of your financial queries. I'm Avan Dabash, and let's start off the show with the headlines. The winter session warms up as the Congress leader P. Chidambaram asks why the delay in bringing petro products under GST. FM Jaitley replies on the floor of the House saying it is the states which first need to decide on building a consensus before the GST Council is pressed into motion. A big exclusive as the controversial IBC norms that bars bids by promoters and ineligible applicants may undergo a massive overhaul. The government may fix some of the concerns raised by India Inc., in effect making the ineligibility norms easier. And markets knock on fresh highs as the year draws to an end. An early Santa rally on D Street. The markets look beyond the election mania to search for value near record highs. Guys, first introduce the guest. Those are your top headlines. Well, let's begin the show by bringing on board our expert. Remember, today we're doing a special on all your tax-related queries. So any questions and queries that you have on tax will be addressed today by Mr. T.P. Ostwal. He's tax expert joining in live from Mumbai. Thank you so much, Mr. Ostwal, for joining in. I'm going to come to you in just a bit, but first, as 2017 draws to a close, top market veterans are looking at placing winning bets next year. Let's hear out Ramdev Agarwal and Manish Sonthalia on where they're seeing value as they speak with ETNA's executive editor Nikunj Dadnia.
In a portfolio of 20 stocks, you'll find some of the stocks overvalued. I mean, we might be committing a mistake of buying the right stock but at wrong price. Or you could be buying the wrong stock per se, whose the trend itself will go negative, like say pharma or some IT stocks. So those things will happen, but I mean, happily, all the things don't happen together. So, in 17, say 16, IT slowed down. In 17, pharma took its own toll. You know, so in the portfolios, that kind of but then don't forget, while this is happening, BFSI is going through the roof, private sector banks are going through the roof, oil companies are doing very well, some of the consumer companies are doing very well. So, it's a counterbalance. I mean, it's not that in a portfolio of 20, all the 20s are going up. So, the whatever concerns are there, a lot of it is taken care of by diversification.
Manish, in last 10 years, which is one stock you regret buying and which is one stock you regret that you sold early?
Yeah, so sold early were many, and this was again a learning. You know, we had a Shri Cement bought at 1600 rupees. That was exited, and now today it is maybe 17,000 rupees. We had an MRF which was at 2,000 or 3,000 rupees, which is today 70,000 rupees. You know, so there are many names, you know, which we actually ended up, and this was again based on a premise that these were commodity stocks. I mean, again, this is a learning from this portfolio that many commodities can also become brands, you know. So some of the names, you know, the way the business model evolves in many of these businesses again changes over a period of time.
Okay, that's a market view coming in from the two main men at Motilal Oswal. Well, let's move on and speak about some of the important things that you need to know when it comes to tax saving. As I said, we have Mr. T.P. Oswal with us. And Mr. Oswal, let's start off with the first topic of discussion that you spoke about. Tax saving when it comes to fixed deposits. Can you highlight for us what individuals are eligible for and what really are the benefits of the same?
See, as far as the fixed deposit is concerned, you are entitled to the deduction on account of the amount deposited into the bank up to 1.5 lakhs tax saving fixed deposit or ELSS deposit, which is deposited with a mutual fund by the banks. There is a concept called as ELSS, equity linked insurance scheme, and those deductions are available up to 1.5 lakhs of rupees and nothing more than that. So, under section 80C of the Income Tax Act, you can claim the deduction of investment up to 1.5 lakhs in the tax saving fixed deposit. and the amount so invested is deductible from gross total income. That is all, nothing beyond. So, these deposits include the FDs in a bank, the post office deposits, post office fixed deposit, and interest earned as a taxable income of the investors in a bracket. It is the interest earned thereon. So, therefore, all these deposits which are required, there are conditions precedent behind this deposit. You have to keep the deposit for 3 years. So, therefore, your monies are blocked for 3 years. You can claim the deduction. That is all, nothing else.
Very much for giving us that clarity. We've got some questions and queries for you as well. Let's take on board Rohan's query. He says, he sent us an email. Now he says, my father who's retired is invested in an under construction property in Mumbai. He will be paying the stamp duty and the registration in November. In December, and he is looking to get possession of his flat by next year. That's 2 years later, that's December 2019. He owns another flat in Navi Mumbai, which he wants to sell in 2019 and invest that money in the under construction property. Will it help him save long-term capital gains tax, and how should one really go about it? A fairly valid question. Can you help us understand that when it comes to properties, those which are under construction, what exactly are the tax implications, and when are individuals such as Rohan's father exempt from the same?
Say, if you hold any asset which is a long-term residential house, first condition is very important, and it becomes long-term after holding 2 years. So, if you sell that house, the gain thereon is considered as a long-term capital gain. Now, you have option of investing into another residential house. You sell one residential house and buy another residential house. The question is, it is not necessary that you must first sell and then buy. You can buy first and then also sell the residential house. The conditions are, if you sell first and then buy residential house, you must buy it within 2 years. If you first buy and then sell your existing residential house, it must be within 1 year of your purchase. So, first you have purchased, then first you have say purchased new house, and then you want to sell your existing house, it must be sold within 1 year. Then both are long term, and second thing, when you buy new house, that new house must be kept for 3 years minimum. So, whole of the capital gain made on account of the sale of the old house will be fully exempted if the new house is purchased is equivalent to the amount of capital gain which you have made on account of sale of that house. So, if you have invested into the new house which is less than the total capital gain which you have made, then proportionate deduction will be available. For example, your capital gain is 5 lakhs or 5 crores and you have purchased the house worth only 4 crores. You will get the deduction only up to 4 crore, 80% of the capital gain will be exempted, 20% of the capital gain will be subject to tax at the rate of 20%. And the 20% rate applies because it is a long term capital gain. If it is a short term capital gain, this scheme is not available. Section 54 scheme is available only in case of a long term capital asset sold. If it is a short term capital asset, this section is not available. I hope I have made it very clear.
Rohan, you were able to understand some of the implications that Mr. Ostwal spoke about, how it is exempt under Section 54 of the IT Act with respect to this residential property sale if the amount is overall invested into a new residential property as well. And it's important that the construction that you spoke about of the property that your father is invested in must be completed within 3 years of sale. So that's how really you can look to save tax when it comes to investing in properties under construction. Let's shift gears. We've got another question, and this one has been sent in to us from Rahul Srivastav, an email question sent in. He asks, is the interest received on the post office schemes such as the KVP, the monthly income scheme and recurring deposit or term deposit taxable for senior citizens? How would you address this question for each of these various schemes? And Mr. Ostwal, let's start off with the Kisan Vikas Patra and the kind of tax exemptions that each of these schemes enjoy, if they do or not.
Vikas Patra interest received is fully it does not have any tax exemption.
Okay.
It's fully taxable. When interest is paid to you, there was a time earlier it was exempted, but now it is not at all enjoying any exemption. You will get the interest which is subject to tax deduction at source by the post office or the authorities issuing this Kisan Vikas Patra, and that will be under section 194A. Interest earned on Kisan Vikas Patra is therefore fully taxable as per Income Tax Act and as per the slab of your income tax rates. For example, if your income is falling less than 5 lakhs of rupees, up to 2.5 lakhs of rupees you are exempted, and beyond that it is taxable at 10%. So, the rate of tax will be 10%, and that is taken care of by TDS done by the post office or the authorities issuing the bonds to you, patra to you, and therefore, there will be no further liability. But if the interest falls under 20% bracket, income falls under 20% bracket, then 10% will have to be paid by you further. If the income falls under 30% bracket, then you will have to pay 20% tax, because the tax deducted at source is only 10%. And the tax deduction will happen only if the interest on such Vikas Patra is more than 10,000 rupees. So, similar is the position on monthly income scheme, recurring deposit scheme and time deposits in the post office or even the bank. However, please note, if you do not give your PAN number to these authorities, they are obliged to deduct tax at source under section 206A at 20%. So, please be careful to deduct to give your PAN number to these authorities. However, just these days now KYC requirement makes it mandatory for you to give PAN number, and therefore, I presume everybody must be giving their PAN number. So, deduction of tax at source is supposed to be at 10%. But in India, we have very large population and very less number of people holding PAN number, and therefore, this problem could arise.
All right, I hope you took note of the various tax exemptions for senior citizens under the various schemes that Mr. Ostwal highlighted. Interest income fully taxable under the monthly income scheme, 10% interest earned will be deducted at source for some of the term deposits, and he also ran you through what the outlook for the Kisan Vikas Patra, where the interest earned doesn't enjoy any tax exemptions. On that note, let's slip into a quick break right here on the show, and as we do that, here's a quick programming note. We have a special coming up on Monday 2017. We want to know if Brand Modi is still invincible, whether Raga has arrived despite the defeat. We talk about the battle of brands, Rahul Gandhi versus Narendra Modi on our brand equity special that's coming up next at 6 p.m. with a galaxy of guests to talk about just that. Stay tuned. Welcome back. It's our tax special right here on The Money Show. We're in conversation with Mr. T.P. Ostwal, and he's helping you out with all of your tax-related queries. In fact, we're getting quite a bit of an overwhelming response, Mr. Ostwal, by viewers who are watching the show as we speak. Let's connect with someone who's called us in right now, and he's got a tax-related query. Ravindranath Saxena is connecting with us from Bhopal, and he's got a question. What is your query, Mr. Saxena?
Let me congratulate ET Now for creating wealth for the investor.
Thank
you.
I
have got two queries. One is about short-term capital gains, and second one is about dividend income if it is exceeding rupees 10 lakh in a year. As far as taxation status of long-term capital gain is concerned, it is clear that no tax is payable on long-term capital gains. In case of short-term capital gain, suppose we are incurring expenditure or on interest, brokerage, or mobilizing additional capital or security transaction tax. My query is that these expenditures are deductible or not. In case of dividend income, if my dividend income is likely to exceed
Saxena,
rupees
let
10
me
lakh
get the
per
first question answered. Let me get the first question answered. You heard out his query, Mr. Ostwal. What is the outlook when it comes to the expenditure deductible for short-term capital gains?
See, his question is on the deduction from short-term capital gain, and I suppose it is on account of the listed company shares sale. And if the listed company shares are sold, he is entitled to pay concessional rate of 15% tax, provided the STT is paid on those sale proceeds when he sell the shares. So, the rate of tax will be 15%. Now, however, if he has expenses which are deductible, for example, brokerage, STT, everything is deductible. In my opinion, including interest, if he is legitimately borrowing which is made for the purpose of making investment, even interest is deductible. And therefore, net capital gain thereafter will be subject to 15% tax.
Okay. Are you still with us on the phone line, Mr. Saxena?
Yeah, I'm on the line, and I have got one more question. If my dividend income is exceeding 10 lakh rupees, how it is accessible under income tax?
Mr. Ostwal, to you.
See, if you are individual and partnership firm earning or trust earning dividend more than 10 lakhs of rupees, the excess of 10 lakhs of rupees, up to 10 lakhs there is no further taxation in your hand, but anything in excess of 10 lakhs of rupees will be subject to 10% tax in the hands of the individual or the person receiving, except in the case of companies.
We were able to answer your queries. Thank you, Mr. Saxena. We have another live caller from Goa. Rajendra joins in. Sir, welcome to the show. What's your question?
Ma'am, I'm an insurance advisor.
Okay.
And to generate the business, sometimes we have to share the commission. Can I claim the deduction for that expense as an expense?
Can he claim the commission that he shares as an expense? That's what he has to ask. Mr. Ostwal, what would you like to tell Rajendra?
In my opinion, he should be able to claim the deduction provided he proves an identity of a person who has received the commission, and if the amount of commission exceeds beyond the threshold prescribed under section 194D or H, as the case may be, he has to deduct tax at source, and if he has done that, he should be able to claim the deduction. There is no problem.
Okay, so you should be able to claim that deduction. But I'm afraid we're completely out of time, Mr. Ostwal. It's been lovely having you with us. In fact, given that we're getting such an overwhelming response and we weren't even able to discuss all that we had planned, I think we're going to get you on board very soon again for a tax special on The Money Show. Thank you so much for joining in, and thank you to our viewers for watching.